Hello and welcome to session 19 of our Series 7 exam overviews, brought to you once again by Passing Score, where you can get more help on your exam prep at PassingScoreFinance.com. In this video, we'll be going over equities. And as you can see, we have a few topics to go over. Let's start with the basic unit of corporate ownership, common stock. This includes most of the voting rights of a corporation, along with a lot of the risk as well, which means it has a higher potential for capital appreciation along with that risk. It also can receive dividends, but only after preferred shareholders, and those dividend payouts aren't guaranteed in any case. Preferred shareholders have higher priority than common shareholders in terms of liquidity and dividend payouts, but they typically don't have any voting rights. And they can be flexible in terms of their structure. And we'll take a look at some of these features later on. As Since common shareholders can receive a lot of the gains, they also take a lot of the risk, and we can see that here in this bankruptcy liquidation order. They're normally at the bottom with preferred shareholders just above them. Common shareholders do have certain rights, however, the right to a stock certificate, to transfer shares, and the right of inspection of certain books and records of the corporation. Shares are typically maintained by the corporation in these three ways. The first, the total number of authorized shares that the corporation can issue, which is specified in the corporate charter. Then the number of shares that are actually sold out to the public or granted to employees. These are the issued shares. And then there's treasury stock, which are shares that have been reacquired or purchased by the firm. And you can think of these as kind of dormant shares. They don't vote, they don't receive dividends. They're just maintained on the books of the corporation until they're reissued out again. Outstanding shares are an important thing to know. These are the number of issued shares less any treasury stock that has been reacquired by the corporation. We have our normal dividend payments, which are made in cash. These are paid out from retained earnings and voted on by the board of directors. And there's an adjustment made to the stock price for cash dividends on a per share amount. And this is normally made by the exchanges so that they trade ex dividend with the shares adjusted at that time. And here's our different dividend dates. First, we have the declaration date when the board votes to authorize the payment. They'll specify a specific payment date and a record date. And this is the last day on which you can own the shares and still receive the dividends. If you sell the dividends the day after the record date, you'll receive the dividends, but the new owner, the new purchaser on the ex-dividend date will not receive the dividends. And this is typically the second business day prior to the record date, since it will settle after the record date. We have stock dividends, which are shares that are paid out to shareholders. And this is really more like a rearranging of the number of shares than a true payout to the owners. Nothing really changes except the number of your shares, and your price is adjusted proportionately so that you still add up to the same ownership. No effect on assets or market cap. And here's an example to give you an idea. If you own 100 shares and you receive a 10% stock dividend, which is declared and paid out, you'll own 110 shares afterwards, but your stock price will be adjusted downwards by 10%. So you'll have the same proportional ownership in the corporation. We have stock splits as well, which is a more extreme example of a stock dividend, actually, in which in that we adjust the number of shares in the stock price, but it's really no change to the assets or the market cap. So in our example here, we have 100 shares at $50 a share. And after the stock split, we have 200 shares at $25 a share. So you see the total hasn't really been changed. And options and other derivatives, other things tied to the stock split, to the shares, are also adjusted for the split. We have the reverse calculation, which will reduce the number of shares and increase the share price. So in our example, we have 200 shares at $5, which is converted after the stock split to 100 shares at $10 a share. And in this case, this is normally done to boost up the share price because there's certain minimum share prices that have to be maintained so that you can keep trading on some exchanges. So a reverse stock split can keep the corporation from being delisted from an exchange. We have different types of voting as well. We have statutory voting in which one vote per share per director is granted, and you can only vote each of your shares separately for each director. So you have 10 votes for one director, up to 10 votes for a different director, and so on. And this is as opposed to a cumulative voting scheme in which all the votes that you're granted can go all to any which way you please. That you can, let's say there's three directors that are open director positions, and you're granted 10 votes for each of the directors because you own 10 shares. You can put all 30 of your votes into one candidate or split them up any which way you please as opposed to statutory, in which you'll have to keep each of those 10 votes separate. We also have something called preemptive rights, and this is a right of an owner that's granted to an owner to maintain their proportional ownership in a corporation. So if you have a 10% ownership in a corporation that wants to go out and raise money, the new shares that they issue may dilute your ownership below the 10% that you want to maintain. So you're granted the right to reinvest in the corporation at a subscription price, and you're given this right for a limited time so that you don't hinder their fundraising process. So if you're willing to put in additional money, you can have the right to keep your 10% ownership. If not, you'll be diluted down by the additional new shareholders. And we have warrants, and these are, for all intents and purposes, like long-term options. You're granted the right to purchase shares at a specific price for a certain number of shares, and this is typically done to help with borrowing costs. They're granted with loans or bonds, or even in cases where a company is leasing a building, they might issue warrants to the landlord in order to induce them to give you the property, to lease you the property, or do so at a preferential price. And we have the different preferred stock types, which we alluded to earlier, based on the different structures that you can create from the features of preferred stocks. We have cumulative preferred stock, in which your dividends accumulate, whether they're paid out or not. You're still owed those dividends when any are declared in the future. We have non-cumulative, in which you're not guaranteed those past payments. And we have participating preferred, in which you'll, as a preferred shareholder, will receive a dividend payment and also some percent of whatever is granted to common shareholders as well. So you participate in those common dividend payments. We also have callable preferreds and convertible preferreds. Convertible preferred means that you can convert your preferred stock to common shares when you choose to in the future. Let's say the common shares really start to take off in price. You might want to convert your preferred 5% dividend payment into that high growth common stock. So in this calculation, we might have a $30 par value at a $10 conversion price, which means you'll be able to receive three common shares for each one of your preferred shares whenever you choose. Uh, we also have a current yield, which is a basic return calculation on the share. So you take your annual dividend payment that you've received and divide by the current market price, and that'll give you your current yield or basic return that you're getting on your shares. Stocks can also be broken down by the type of investment that they essentially create because of the underlying company. So we have blue chip stocks, which are issued by large, mature, steady corporations, growth stocks, which are high growth types of companies, income stocks, which are corporations that issue high, regular, consistent dividends. We have defensive stocks, which are corporations that don't tend to move too much along with the economic cycle. And we have cyclical stocks, which are actually sensitive to the business cycle. They move up and down um, strongly along with the economic cycle. And then we have ADRs, which are foreign shares held by a US bank, which issues the ADR, whose value is tied back to those foreign shares. And it's a way for US investors to invest in foreign securities. And that's it for our equity section. If you have any questions, please feel free to email me at john@passingscorefinance.com. And as always, good luck on your exam.